Welcome to Flexible Budgets Part 2. This ACLED is a continuation of Flexible Budgets Part 1. By the end of this ACLED, you should be able to prepare a flexible budget. In the previous ACLED, we recognized the limitations of static budgets when we want to compare our actual results to our static budget or plan. If we actually sell more or fewer units than planned, we won't be able to compare our actual results to our static budget. We'd expect every variable cost amount to be different than what we had budgeted, and this isn't particularly useful information. The solution is to prepare a flexible budget, a budget based on the actual number of units sold. If we did everything exactly as planned, except we sold more or fewer units, our flexible budget should be identical to our actual results. This means that we'll be able to see where we didn't do things exactly as planned. This is useful information. We'll work through an example using a company called R&H Cube. R&H Cube offers tax preparation services. Here is Cube's data for March 2026. Yikes, that's a lot of writing to wade through. So let's organize the information first. We'll set up a section for budget data and one for actual data. Then, spoiler alert, we'll be organizing our flexible budget according to the contribution margin income statement pattern. So we'll organize our two data sections the same way. The first thing we look for is budgeted sales or selling information. We expect to prepare 1,100 tax returns, and our expected revenue or fee per return is $190. Next, we look for our budgeted variable costs. Expected direct materials cost per return is $5.50. Expected direct labor cost per return is $45. And expected variable overhead cost per return is $6. Last, we look for budgeted fixed costs and find that we expect them to be $8,000. Now we look for actual data, starting with selling or sales information. We actually prepared 1,090 returns and earned an average of $200 per return. Then we look for actual variable costs. Actual direct material cost per return was $5.60. Actual direct labor cost per return was $42.50. Actual variable overhead cost per return was $7. Last, we find our actual fixed costs were $8,200. Now we're ready to prepare the flexible budget. Start with the usual three-line heading, company name, report title, and date. The report title is Flexible Budget. Since we'll use the contribution margin income statement layout, we need the long form of the date, the whole accounting period. So for the month ended March 31st, 2026. We'll need 4 columns after our row labels, one for flexible budget, one for actual, one for the difference called variance, and one called U or F that we'll explain shortly. Our row labels follow the contribution margin income statement pattern. So sales, then a variable cost section, which includes direct materials, direct labor, and variable overhead in this case, then contribution margin followed by fixed costs, and finally operating income. We'll work our way down the flexible budget column first. Remember, the whole point of a flexible budget is to eliminate any differences between budget and actual that are caused just by our selling more or fewer units than planned. So our flexible budget calculations will always use the actual number of units sold along with the rest of our budget data. Our flexible budget sales amount is 1,090 actual units sold times budgeted selling price per unit, $190, for a total of $207,100. Our flexible budget direct materials value is actual number of units sold, 1,090, times budgeted cost per unit, $5.50, for a total of $5,995. Our flexible budget direct labor and variable overhead values follow the same pattern. Use actual number of units sold along with the budgeted cost per unit of product. When you calculate the contribution margin, Remember that you're subtracting the variable costs from the sales amount. Our flexible budget contribution margin is $145,515. Since fixed costs are not affected by the number of units sold, and we were given a budgeted dollar amount, we just pop in the $8,000. Then we subtract to get flexible budget operating income of $137,515. Next, we work on the actual column. This column uses all actual data. Using all actual data, our operating income is $149,741. To get the variance or difference between our flexible budget and actual amounts, we subtract across each row and enter the absolute value in the variance column. Enter the difference as a positive amount. The difference between 207,100 and 218,000 is 10,900, and so on. You have to do the math across each row. You can't do the math down the column as you did with the flexible budget column. Now we know how much each variance is. The next step is to determine if the variance is unfavorable or favorable. The first variance is sales. Generally, would you hope that your actual sales revenue be higher or lower than your budgeted sales? Higher. Since actual sales are higher than budgeted sales, the $10,900 variance is favorable, so we enter an F for favorable. The next variance is direct materials. Generally, would you hope that your actual direct material cost is higher or lower than your budgeted cost? Lower. We hope our actual costs are lower than our budgeted costs. Since our actual direct material cost was $6,104 and we only budgeted $5,995, the $109 variance is unfavorable. Pause the ACLED here and see if you can determine for each row whether the variance is unfavorable or favorable. Remember to check the line label first to see if you're working with a cost or a revenue related row. This concludes the ACLED Flexible Budgets Part 2.